Today I'm going to talk about why this great stock market we've been having year to date is on the verge of decline. The stock market has been wonderful year to date, generally. The S&P 500 has gone up about 17%. The NASDAQ has done even better. It's gone up 35%. And I love to trade the QQQ, which are the 100 largest companies on the NASDAQ. And I particularly love to trade the TQQQ, which is triple leverage bullish fund on the NASDAQ 100 largest companies. And artificial intelligence has been what's been driving the market up in many ways. There's been good things happening with inflation. The CPI and the PPI are both down, which indicates that the pace of inflation is coming down, and it's going to keep coming down. But I think we've got a warning sign this last Friday of how easily this market can be stopped in its tracks. And we're going to keep getting good information and good news on inflation. But the question will be, is the news getting to be too good? Is inflation going to go down so much that we start to deflate? When you start to deflate, you're in danger of going into recession. And so I'm going to give you these warning signs. I'm going to talk about what's been driving the market up recently and the warning signs that indicates that it's going to go into at least a temporary decline. I believe it'll recover after that, but we got to hope that it doesn't deflate too much and go into recession. So what is the stock market showing us now by the performance of the stocks in the QQQ? Well, Meta, which used to be Facebook and now includes all kinds of applications, Meta, they started going up because they reduced their expenses, but now they're going to reproduce Twitter, and they're going to call it Threads. And Twitter isn't doing all that great, and it's hard for me to see how recreating Twitter is going to make Meta go forward that much more. But the stock has been going absolutely off the Richter scale, and people are very excited about this. But I think more is being made of Threads than will ultimately pan out. The big news has been artificial intelligence. And NVIDIA, wow. Friday, it hit 460 at one point before we received the warning sign, which sent everything down. The NASDAQ was flying and going forward and had been for the last Wednesday, Thursday, and Friday. But then Friday, it hit a wall, and we're going to talk about that warning sign. The consumer is in good shape. We're getting earnings back from major stocks. And the bears, we're all hoping, what's really going to stop this rally is that the earnings will be bad. And the earnings aren't bad, and the bears are just simply wrong. But be kind to the bears. We need the bears to keep shorting in the morning so we can make lots of money in the afternoon. Pepsi, as a consumer stock, is reporting good earnings, and that's always a good sign. JP Morgan, wow, they had outstanding earnings. They had 41 billion of revenue, and they had 14.5 billion of profit. That's over 35% net profit. Okay, JP Morgan always cleans up when the other smaller banks are in trouble because they end up being the one to bail them out, and they get a special deal, and they collect all kinds of money on this. And then people are more drawn to the larger banks, and so they get all kinds of depositors. But the banks are generally in okay shape, and it's simply because the Federal Reserve has set up a program where they cannot fail. So the Federal Reserve has set things up in such a way that they learned from 2008. They learned what to do, and they're doing it wonderfully. And they have saved the banks and kept us from going into crisis. So what are the warning signs that we have to look out for that are going to cause the market to go down somewhat? The first thing that happened on Friday that really turned things around, we had all this positive information on inflation, but we got one piece of bad news in the Federal Reserve's eyes, and that was the Michigan consumer sentiment. They were expecting it to come in at 61.8, and it came in much more bullish than they expected. It was 72.6. And it was so much higher than what was expected. This is going to make the Federal Reserve want to raise interest rates because they're afraid of inflation. No, they're going to raise the interest rates on July 26th, and there's over a 90% chance they're going to raise it. It's like 93%. And so we know they're going to raise it a quarter point. So we got this shot over the bow of the ship that, hey, they're going to have to raise it because the consumer sentiment, inflation expectations, the consumer sentiment about how well the economy is doing is much too bullish. It's going to drive inflation up. And then they're going to raise rates at least a quarter of a point on July 26th. But right before they raise the rate, there's another factor thrown in, especially for investors like me that invest in the QQQ. Now, the QQQ is the 100 largest companies on the NASDAQ, but the top 7 comprise 51% of the QQQ. It's called the Magnificent Seven, and that's Apple, Microsoft, NVIDIA, Meta, Tesla, Google, and Amazon. The Magnificent Seven, 51% are composed the QQQ. These 7 companies, it takes 93 companies to make up the other 49%. So what they're going to do is they're going to reset the QQQ so these top 7 companies take up at least somewhat less, like 10, I think it's like 10 to 12% less of the QQQ. Now, I think this is likely to make the QQQ less bullish, at least somewhat, at least in the short term. But they're not worried about the bullish side. They're worried about the downside. That if these top 7 stocks went down significantly, any one of them, it's going to drag the whole QQQ down. And so that's why they want to trade the mix. It's not good in the short run because I think these 7 companies are very bullish and they're going to keep going up. But in the long run, it probably is better because it protects you on the downside. There's less downside risk of one of these companies going down, which is ultimately going to be a long-term good thing. My experience with the QQQ has taught me that right now I want to be trading the TQQQ. This is not financial advice because I don't know your particular situation, and everybody is different and they need to find their own style and do their own research. And I can tell you what I'm doing that's working for me. Maybe it'll work for you, maybe it won't. It's a lot depends on how many shares you buy and the critical timing during the day. But I just love the QQQ because I'm good at reacting to the headline news. And I keep track of that. And the market just swings this way and that way, but it follows the headline news mainly. And I've been able to make money on days where, on Friday, when the QQQ went down overall for given the whole day, I made $5,000 on that. I typically trade the TQQQ, $200,000 at a time. I buy 5,000 shares at a time, and I do 2 or 3 trades. I can do up to 5 trades. I don't want to trade my total trading to be more than $1 million, because that's about half of the 2 million that I have to play with to invest. And if I trade, the way it works out in this strange world we live in, with Fidelity, they keep the money that I'm not using with stocks. They keep it in a money market. They automatically move it into a money market. So if I simply day trade the money, I'm getting 5% interest on it as well. And so I trade $1 million on any given day. And as long as I do that, and I don't hold anything overnight, which actually is a risk nowadays, the way these markets are, I get 5% interest. I'm getting 5% interest for day trading. I'm being rewarded for day trading, and I'm getting pretty good at the day trading, and I follow the trend. Last year I did the SQQQ and I made $350,000. Okay, this year I'm up about 150,000. I was kind of slow to switch because it's so addictive to be a bear in a bear market. Man, you're a genius because you're making money when everybody else is losing money. So you get on this trip and it takes you longer to shift out of it. I actually consider it almost an addiction, the SQQQ. And I much prefer trading the TQQQ, and I will catch up, and I am catching up. We're going to be surprised that we have deflation coming our way. The VIX, the measure of volatility, is very low. And usually you don't have a big crash when the volatility is less than 15. And it's been less than 14 and down in the 13s, you know. So I don't think there's a risk that much of us having a crash. A black swan event can always occur, and you never know when that's going to occur. And that's also why I like the day trading, because actually for me it's safer. For most people it will be riskier to do this, but in my mind it's different for me, the amount of money and the amount of stocks I trade. So you have to trade your own book, as we say. So this most recent week, I made about $20,000. I bought 5,000 shares on Tuesday, and then I've been trading in and out about 5,000 shares at a time. I made about $10,000 on Wednesday and about $5,000 on Thursday, and then $5,000 on Friday. You know, my thought on Friday is, man, it was getting so hot. It was getting so good. I literally said to myself, this looks like it's too good to be true. And I just got out about halfway into the day because I could see. And then that number came out on the Michigan Consumer Sentiment. And man, am I following the economic calendar? I follow Bloomberg's economic calendar, and that tells me what's coming up. And if you're interested in short-term trading, you want to be aware of what's happening on the macro level, because that just seems to dominate this stock market like I've never seen it dominate in previous markets. Thanks for listening and watching. Be sure to hit the like button and subscribe if you haven't already done that. I'll keep trying to bring you the important news and the warnings of what to look out for, but don't let the bears scare you too much. The bears can be scary. They're very scary things, these bears, but they are kind of addicted to their behavior, and it's something to overcome. I don't ever want to be a bear except if the market is actively crashing like it was last year. Thank you.